Morning and happy Monday, everyone. My name is Gav Blacksberg, and I'm the CEO at Wolf and your host for today. And super excited to be having a conversation here around international exposure and where it fits into your portfolio. Joining me today is Jeff Weniger, the head of equities from Wisdom Tree. Jeff, really excited to have you on for the show. I've been really trying to understand deeper and deeper this international exposure, and who better to have than you? Would you mind giving the audience a quick background of yourself?
Sure. And at this point, Wisdom Tree is going to be pushing a 20th birthday, so that might be
Wow.
the background of Wisdom Tree. The original ETF launches in the summer of '06. A lot of them were international mandates, international and emerging, because usually when we say international, we mean international developed, but
Mm.
developed and emerging through all those years, in addition to the U.S. mandates. And I'm the equity guy. I'm the head of equities at the firm, and so I do a lot of the product positioning, thinking about what we should be doing inside the model portfolios. Should we overweight this, underweight that? Putting together a lot of the macro concepts. I love macro with the Twitter charts and everything like that. I guess we don't call it Twitter anymore. We call it X.
Call it what you like.
I call it Twitter. But yeah, this would be great. We'll talk EFA mandate. We could talk emerging too. Whatever direction you want to go.
Perfect. Yeah. I mean, we'll definitely start with some of the high level macro. Prior to doing this, just for those that are watching the discussion here, a disclosure from the top, because we are going to be talking about specific investable products, ETFs here. Investors should carefully consider each fund's investment objectives, risks, charges, and expenses prior to investing. The fund's prospectus and summary prospectus contain this and other information about the Wisdom Tree ETFs. If you want to obtain the fund's prospectus and summary prospectus, please visit their website. It is wisdomtree.com. And the fund's prospectus and summary prospectus should be read carefully prior to investing. Excited to be working together with y'all. And a big thank you to SIBO for helping to sponsor and set up this live stream. With that being said, let's get right into it, talking about the international exposure. So kind of just starting from the top with international equities becoming more and more attractive compared to US equities, and why that is happening from a macro perspective. Would love for you to start there.
Sure. Well, I mean, it's in when we say becoming, I guess you have to put a start point on it as to when this
Yeah.
really started to occur. And it depends on the countries, but generally the interest in EFA mandates, of course, that stands for Europe, Australia, and the Far East. It's generally the parlance we use to describe developed economies. You might put it about 5 quarters ago, somewhere around the beginning of 25, where a lot of people started to gain interest.
Mhm.
There was some stuff absolutely melting up last year. And so, I mean, basically everybody, European nations were melting higher, but East Asia in particular was piping hot and remains piping hot. So the grab for these assets has depended on which nation you're looking at. If you look at Japan, for example, that bull market and that bout of outperformance, if you're in a currency hedge concept, really started almost a generation ago. People don't realize it, but if you look at 5 and 10-year windows on Japan, if it was currency hedge, has been beating the S&P 500.
Yeah.
Last year, Japan went vertical. Last year, Korea went vertical squared. I mean, Korea basically, for all intents and purposes, Korea doubled last year. And then generalized developed economy mandates, which is going to engulf much of the UK, France, Germany, Australia, and so forth. Those handily beat the S&P last year. So I'd say most of the interest is started to arrive around Thanksgiving-ish. And then now at Wisdom Tree, in terms of just sentiment and marginal propensity to
Yeah.
have flows, much more so in the first 2 months of 26 than most other periods of my career, because the stuff's finally
Interesting.
working.
Yeah, I mean, I guess the flows do often tell the story, right? Where the money
Mhm.
moves seems to be where the interest is. Two of the products that we'll look at here are going to be DDWM and DDLS. Can
Okay.
take a look real quick just at the flows, and I'll show this on screen as well so people can visualize it to get an understanding of what's happening with these products. We're going to just pull up my handy dandy Y charts here for a second and show people. So you can see here, this is DDWM, the Wisdom Tree Dynamic International Equity Fund. So as you can see, obviously the price chart has been very compelling, right? Just
Mhm.
continuously moving up here. That's just year to date. You can zoom out here and see, from the lows of 33 all the way up to here. But like you mentioned as well, those total assets under management really continuing to escalate here
Mhm.
significantly over the past year. This moved from a sub $400 million fund. It is 1.3 billion, so almost $1 billion coming in. And then just this year alone, going from right over a billion to 1.34. So hundreds of millions of dollars coming in here. So clearly, like you said, massive attraction. And maybe you can
Mhm.
talk a little bit further as to, what you think is going to happen next, where the opportunity lies here.
Sure, and I didn't know we were gonna do screen shares, so that's pretty cool. Yeah, okay. Well, look, with DDWM, and remember, generally, what I'm doing for a living is talking to advisors,
Hmm.
right? And if you think about what the pain points for an advisor, and this is just a function of Americans talking to Americans about how to allocate assets for other Americans.
Mm.
If you really think about it, and it's the old maxim of nobody ever got fired for buying IBM,
Yeah.
which is a little bit of a joke because I think IBM was down like 12% the other day. So, but nobody ever got fired for buying Procter and Gamble or Coca-Cola might be one of the
Sure.
arguments.
Apple.
And exactly, exactly. And if you think about, okay, so think about a bear market and we send the S&P down 20% in some bear market.
Mhm.
To the extent that in that bear market, let's say developed stocks do worse and they're down 22%, right? Everybody's taking a bath, but when the end client is complaining to the advisor, it's that line item for the developed stocks because they were down more. And why didn't you just give me the S&P 500 tracker and I'm more comfortable? I recognize these companies. And so you end up getting slapped across the face a little bit more when stuff's not working. And you don't really get so much credit from them when they're outperforming. And it
Mm.
might be, well, why did you only have me in 5, 10, 15% in these stocks? Didn't you know that,
Yeah,
the
yeah, yeah.
S&P was overvalued and so forth? So one of the things about DDWM that has interestingly been the reason why when somebody brings new money into it has been, I think, the vol metrics on it. Now, I mean, the fund has been kicking butt through the years. It's dynamically currency hedged. So you're never basically totally exposed to the other currencies, which is a key part of the vol metrics. It tends to have, knock on wood, because it's past tense, downside vol metrics that are really performance and vol metrics that are really, really nice. And so what you oftentimes find with our currency hedge mandates, get something in my eye here, is that when you compare them on 5, 10-year numbers, you'll have standard deviations lower than the S&P 500,
Interesting.
which blows people's minds. Because if you think about also the mentality, and I think it depends a little bit on when did you start paying attention to markets and what are your own mental rigidities.
Yeah,
So, for example,
bias.
yeah, your own biases, right? Like where did you yourself really take a bath, right? Where did you really make a pile of money?
Mm.
And for example, my bias, of which I'm able to identify it, is I'm always looking for the next .com because I was a teenager becoming a guy in my 20s, and then the .com thing blew up, and so you're always looking for it. And you think about some of the older guys in this industry, inflation is always around the corner because, well, I guess at this point, many of them are starting to retire or are retired. But if you were 15, 20, 25 years old in the 1970s, you'll see inflation is coming at any given moment because it's formative years. And so if you start thinking about international mandates, the global financial crisis was ending. And then we still had these several years where we're now in a raging bull market because the stock market bottoms in March of 09. 2009 was just a melt up. We're continuing higher into 2010. 2011 has those rough patches because the Greek crisis. And for all these years, 11, 12, 13, 14, well into the middle of the decade, it was always, you know what, it's going to be the European banking system's going to creep up on us. I'm worried about the euro even staying as a common currency. These were the
Right,
concepts.
Brexit. Yeah.
These were the concepts. And so essentially, if you're thinking about, okay, upside and downside, you've got an asset allocation pie chart and what could go right and what could go wrong. And maybe what really hit me hard. That 2011 sell-off was a real scare. There was, it looked like Greece was going to leave the Eurozone. I mean, it really did. And this is now ancient history, but this was the thing that, like, right now it's SaaS Mageddon, SaaS apocalypse. in the last 3 or 4 months, and I
Right,
guess
with
maybe
AI.
over the and now it's Iran, right? But at the time, for 4 or 5 good solid years, it was the European banking system. And essentially, what would happen is when you're risk on, European stocks are going up, and the euro is going up. And so let's back of the envelope this. Let's say you're making 10% of the stocks and the euro rallies 3%. It's not additive, but let's add them together. 10 plus 3, you made 13. All right, cool. And then on the downside, let's say you do 10 and 3 again. You're down 10, but also you're losing the 3 on the euro. You're down 13. And so you're like Richter scaling this, which
Mm,
is the last thing you want in a portfolio. You start thinking about a DDWM or many of the other currency hedge mandates. You're still getting the 10 or the other 10, but you're not getting that other 3, or you're only getting a portion of it because you're currency hedging it back to the dollar.
interesting.
And I think that's really the appeal of these things.
Yeah, certainly that's a huge part of the international appeal. One thing which I'd love to hear you talk about as well as to maybe why people are gravitating towards international exposure as well as maybe things like gold is a little bit of
Okay.
the lack of trust that people are seeing as much in the US market, in the US dollar, and pieces along those lines, and how that's translating internationally.
Yeah. And it's we're pretty lopsided here in terms of dollar sentiment. I got some charts floating around that could get a relief rally in the dollar. And so and we have gold mandates too. I mean, it's wisdom true. We've got mandates for everything. So to the
Right.
extent that you would anticipate the dollar maybe rallying, which there's not a lot of dollar bulls, I'm one of the few, then maybe gold would take a breather in dollar rally. Although I would tell the tried and true gold bugs to take a look in the last 3 or 4 years as gold has rallied. It rallied also during windows of time where the dollar was appreciating,
Yeah.
which is a really weird historical anomaly. It doesn't usually work that way. But if you look at the BofA Fund Manager survey from about a week or two ago, dollar positioning is as bearish as it's ever been in data back to 2012. So maybe you get a little bit of a dollar relief rally. Now, if you're in, let's just take, just throw a dart at the map of the world and pick a country.
Sure.
Let Great Britain or something. So if you're in British equities, and the pound sterling is appreciating, then you're going to make doubly good, I guess you could say. And if the pound sterling is depreciating, it's going to cut into your gains. If you're a wizard and you've properly identified that British equities are going to rally, then sterling could work against you. That's why we always say currency hedge it back. That would be a country that in most developed mandates is a large one. It's
Mm,
generally not just at wisdom tree, but at most either cap weighted or modified cap. We do a modification of cap weighting with the dividend weighting in DDWM and DDLS. Britain is usually the second largest nation. These days, with Japan rising to about 5% of the global basket, Japan is about a quarter of DDWM and DDLS, and it's one of the things. I mean,
interesting.
Japanese equities is one of the things that Wisdom Tree's on the map with. We're number 2 behind BlackRock in
Wow.
Japan fund. Yeah, I mean, it's if you think about in the Japan funds specifically, we're number 2 behind them, and we pick up a lot of Japan across the mandates because that's probably been the number one success in developed economies over the last 10 or 15 years. I mean, I don't think anybody would even argue against it. Who's been, in terms of turning a moribund economy around? I mean, other than maybe in the last year where the Koreans really seem to get their act together, but that's partially the AI trade. Certainly Japan. I mean, it was like an untouchable. and now people are playing it.
What do you think about the movement that we've seen in terms of Japanese interest rates in the yen and how that plays into that?
Yeah. Well, if you look, and one of the things I was tweeting about a couple weeks ago is also now you got a little bit of a rally in the last 3 or 4 weeks. So we'll wink to that. But yeah, you're referencing a pretty ugly sell off over the last year or so. The thing I was referencing is that it's not unique to them. German boons have been dumping as well on the long end. And that was something that was a little bit counterintuitive because the US bond market from 10s to 30s has been pretty stable, if not rallying for the better part of about a year or so. But one of the things that I would point out is I have like a factoid that I like to mention. Um, And I'm going to guess that basically nobody on planet Earth knows it unless you're totally wonking out. And this is not specific to the Japanese. It's the American situation as well. Think about this. I'll tell you the statistic, and then you tell me if I'm a liar if I tell you 99 out of 100 people think this is not true.
Mm.
The US debt to GDP ratio peaked 5 years ago and has declined about 11 percentage points since then.
Yeah, I don't think people would assume that based on what they hear about the US debt.
I mean, it was 132 and now it's 121. Now it's been going up a percentage point or two for a couple of years. But the high in the US debt to GDP ratio, which was 132, was during COVID. And it's down. And I don't think that I could call most people in the industry, forget dentists. No
Right.
offense to any dentists watching this, but like people who are doing this 50, 60, 70 hours a week, I just don't think that's the case. I don't think anybody knows that.
Doubt
The
it.
Japanese debt to GDP ratio peaked at 220 during COVID. And basically by the end of this decade, it's going to be in the 190s. Now
Mm.
I don't want to sit here and say 190% debt to GDP ratio is something to be popping champagne about, but it's on the mend. And if you think about, because the big primary risk to Japanese equities is 30-year JGBs keep selling off on account of fiscal largesse. And now it's time for us to dump the Nikkei. That's really what it boils down to. But if you're growing nominal GDP at a faster pace with which you are accumulating debt, your debt to GDP ratio will decline. And I just don't think people know it. So we'll see if that ends up being something that stabilizes there. There is still the TINA trade for Japanese equities. So, you could just kind of do the rough arithmetic on it. Where are we in U.S. stocks? Call it at this point, because we've been chopping sideways while earnings have caught up. Call it like a 22 times forward earnings for the U.S. So let's for the math to be easy, let's say it's 20 so that we can easily divide 1 over 20. All right. So U.S. equities, let's say it's 20 times earnings, even though wink, wink, that's not the multiple. It's like 22. That's a 5% earnings yield, 1 over 20. Now, let's do cash. All right. Cash is, you just pull Jay Powell or Kevin Warsh, that's going to be about 350, right? Depending. So you're 150 over cash to engage U.S. equities, and then theoretically you would grow those earnings and so forth. But in a snapshot here and now, 150 over. All right, so let's take the Bank of Japan now. So we're going to do cash over there. And let's say that they aggressively hike, because we're being devil's advocates here, as opposed to cutting or chopping sideways on overnight money in Japan. Let's say that sometime soon, whenever soon is, this year, this summer, this winter, call 1% on Japanese money, on money, as opposed to 10s or 30s. All right, now let's call it 16, 17 times forward earnings for Japanese equities. So let's 1 divided by 16, 6 and change.
Yeah.
666 minus the 1, 566 over cash. And then it's like, okay, so you're 150 over cash for US equities and 500 and something over for Japanese equities. And then the pushback is, well, but the Japanese economy, corporations, don't grow earnings like the Americans. It's like, well, then you've not spent enough time on the Wisdom Tree website, because we have all these decks that are showing Japanese earnings growth. It's basically a chart like this, and I'm going up and to my right. It might show up different on the camera. Japanese earnings compared to U.S. earnings. This is the chart since Abe came in, which was 13, 14 years ago. And now you basically take Takaichi. She's been in office for about a minute, right? It's been just a few months. So long as she remains the continuation of the Abenomics trade, which is all signals that I can see out of Tokyo, then I think you can be game on for earnings growth in Japan. I think the number is going to be like, it depends on who you're looking at. Maybe 9 or 10% earnings growth this year.
Yeah.
That's reasonable. So I mean, people need to be looking at DM mandates. There's a lot of Japan in something like a DDWM. I'd have to see, but it's probably in the 20s percentage wise, the percentage that's in Japan and
Good amount.
DDLS might even be like high 20s, because it's down in small cap. So I don't know. You have to pull the data.
Yeah, I mean, some of the top holdings here inside of DDWM, people can look at them, but Toyota, HSBC, Novartis, Nestle, Roche Holdings, Shell, British American Tobacco. But there's a lot of different holdings inside this. It's widely diversified. How many total holdings inside of each one?
Golly, DDWM.
At least
My
100, right?
guess 500.
500.
That
Yeah.
would be my guess. It could be 300. It could be 1,000. The way that I mean, there's so many of these ETFs at Wisdom Tree. We the way we designed these. This goes back to original Wisdom Tree. Is to make it something that has a total market feel in the case of
Right.
DDWM, but without cap weighting it. And one of the things that I don't know if people realize this, but in other countries, basically, it's one of these situations where if you don't pay a dividend, why? With a
Mm,
skeptical raised eyebrow, of it just why? Because here, oh, you don't pay a dividend or you pay a cursory dividend. That's because your name is Nvidia with a cursory
mhm,
dividend,
mhm.
or that's because you're Elon, right? Like Elon's not going to pay a dividend, and so it's cool that you're not doing that, Elon. We like them. It's Tesla, it's Amazon doesn't do it. You get more of a pass in the United States. In the U.S., it's more like if you cut your dividend, why did you do that? That's the only degree by which there's skepticism on dividend payouts. But in a lot of these other countries, I mean, a dividend is just a matter of course. 90 some odd percent of European corporations are paying a dividend, 90
Wow.
some odd percent of Japanese corporations. So when you're constructing a DDWM, you're taking a total universe and you're saying, all right, everybody who has a dividend, you're in, basically. Everybody's in. And then we weight you by your dividend as a proportion of total dividends. So that's why you get a Nestle up there at the top, whatever the amount Nestle was in there. Let's say it's 1%. That's because in the universe of let's say there's 500 names in DDWM. I don't know.
Yeah, yeah.
It's one of 500 companies, but itself it's paying 1% of all the dividends being paid this year by all of the non-US developed economies. So that's why you get Roche up there.
Mhm.
You get Toyota up there. You never end up with some company where you're saying, who? Who's that? Who's this? It's not like a 9% yielder gets you to the top. It's more your yield, it's more your dividend as a function of total dividends. And that's why I mean we want people
Yeah.
DDWM. I mean, it could be the single line item for developed markets because I mean there's hundreds of names in there. Here, how
Yeah,
many we okay, what do you got? This is
I
our
can show
webpage.
people yeah, I can show people a couple of different pieces here from the web page real quick, but just in terms of what you were saying, kind of in terms of
Mhm,
some of the funds breakdown here. So you got,
mhm.
large cap is gonna make up most of this for this one, and that's gonna be the main difference between DDWM and LS. And then
Mhm.
you've got 15% of mid cap and a small amount into the small cap area. You have those portfolio heuristics you were talking about in terms of like the dividend yield, some of the
Yep.
PE, some of those other items. So I definitely encourage people to kind of go on here and kind of poke through because there is a good amount of information. And then in terms of the actual research that you were talking about, people can go through here and look at some of the fact sheets, right, and some of the presentations to see pieces around Japan, Europe, and other items like that.
Here, you're on the website. Let me show everybody something I can do. Scroll up,
Yep.
go to Path Tools. Watch this because you're talking a dollar. Do daily charts.
Hmm.
So if everybody wants to see why DDWM right now or why DDLS right now, look at this chart. Can now click on so this is like our Twitter, except without the BS of Twitter, right?
Yeah.
There's no like photo of like, hey, here's me at the CFA Society of LA. Here's my steak dinner with my wife, like all that stuff you don't care about on Twitter. It's
Hmm.
just our charts. And if you look at this, remember I just mentioned the B of A fund manager survey?
Hmm.
There it is. All right. So if you're in DDWM, that means you will be putting on a position where you are hopeful that the dollar starts rallying. I'm telling you, man, nobody's a dollar bull right now. Nobody.
Mm,
If you're a contrarian, the way you do it is you buy the overseas equities and then you currency hedge it back to the dollar. If the dollar ends up rallying in 2026, which by the way, the euro's stabilizing, then theoretically DDWM would be a good place to be. That's a good one. That's the make sure that you note that the scales are upside down
uh,
on that. This is one for the bears, I guess you could say, where basically the market ends up being quiet or dead money for many years. And this is also one that would appeal to value players because the prior trough on here is around the turn of the century. And we're starting to see some of that action of late in US equities. I mean, materials and energy are up 20 some odd percent year to date, while we have SaaS Mageddon. And that's one of the things that's going on over in European equities as well. The lament for
mm,
a good 10 or 15 years was no tech sector in Europe. I mean, you're hearing it everywhere. And basically with a lot of the concepts of heavy assets, light on obsolescence, the halo thing that Josh Brown and the rest of the gang is talking about, just heavy smokestack, heavy industry in Europe, last thing to get disrupted by AI. And then if people are scratching their head as to why European equities are kicking butt, that's it. It's as simple as that. And so we'll see if it ends up being continuing to be game on. I really like EFA mandates here.
yeah, it's definitely, I mean, super attractive. We showed, the money's also following into it as well. And you can just see a lot of the pieces lining up. And it doesn't feel like it's going to be a total of a year and a half run here. Feels like there's a lot more room to continue to catch up to US markets as well. Now, just wanted to give the audience a quick breakdown from your perspective on the main differences between DDWM and DDLS. They can see DDLS involves small caps as the approach here, and that's going to be one of the big pieces and differences. But are there any
Mhm.
other key differences that they should be aware of?
I mean, they're basically the same thing, just covering different buckets. DDLS would be a sub bucket of it. So think about like
Mhm.
the total market. Think about the total stock market in the US. You have, let's say, the S&P 1500, and then there's the S&P 500 that we all know. But then the mid cap is the net. Look at me blocking my face. It's like the last thing you're supposed to do in a pod is block your own face. But here we're going to block my face. The S&P 500 up here, and then you have the 400, which is mid cap, and then the 600. That's how you get to the S&P 1500. Well, DDWM is the whole gamut. And then if you just want to slice out and take everything that's small slash mid,
Right.
that's this. That's DDLS.
Hmm.
DDLS is the ticker on that. It's lesser known than the big one. But
Yeah.
if you're really live to small caps, we got a small cap rotation going on. Everybody's talking about small working, talking about equal weight working here in the United States. Then DDLS would be a really cool sub bucket of DDWM.
Yeah, certainly not tiny by any means as well here, and has had strong performance. Right. When we talk about DDWM, just for reference, that's up 6.5% year to date, 25% in the past year. DDLS in that same time periods is up actually a little bit more, 7.33% year to date, 28.4% last 52 weeks. So actually slightly outperforming, and you're seeing some of the funds coming into it as well. But it's a great explanation as you did there. And people can see that on the website too, just to kind of show that one more time for those that didn't catch it before. You saw when I showed the breakdown that there was a large portion in large cap. In here, you'll just see, like Jeff was saying, nothing in large cap, about half in mid cap, about half in small cap. And then you
Mm-hmm.
can look through some of the other items as well and get a good understanding of exactly what you'd potentially be owning here, and kind of looking through what some of those top names are when it comes to DDLS. You're not going to see Toyota and others in there. You are going to see names that kind of different from what you mentioned before. You're
Yeah.
probably much less familiar with, right?
Yeah.
Elecnor, Hue, Hafnia. This is going into that area. And so I guess just the last piece is, how do you think about the value being found in small and mid versus large cap? And this is a discussion people have around the US stock market as well all the time.
Yeah. Well, I mean, it depends on your perspective on whether or not we are in the middle of a real staying power type rotation. If you look at the tape, what's been working, what hasn't been working, essentially since, I mean, I'm gonna harken back to when the Nasdaq peaked on October 29th, It's all of those trades of yesteryear are ice cold, right? We're talking about software is ice cold. Tech and comm services are doing horribly inside US equities. New life in European equities. I don't know if I want to throw gold into the conversation because that's been on for several years. But you
Sure.
could even see, you know what? You could even see if you look at a chart, pull up like a 1 year on gold and Bitcoin and just watch these things just do that.
Yeah.
Whereas you couldn't even get away from Bitcoin in a conversation up until it started to roll over. Again, that started to roll over around late October and into November, just like the NASDAQ. So there's a lot of portfolio relooks happening right now. I mean, a lot of people wouldn't even talk to us
Yeah.
about gold. Now we're getting the gold conversations. We used to say with some of like the dedicated Europe mandates, we'd have meetings at Wisdom Tree 23, 24. What do the advisors won't even talk to me about Europe. We can't get any money into the Europe funds. It's just like they just think Mag 7 forever. That's it's a different vibe. It's a very different vibe. I think that one of the catalysts for it has been these big announcements of defense spending in Europe and Japan, where finally they're going to try to goose these economies a little bit. I think that that's part of it. And I think that there's just a lot of people finding Storytime USA to question the AI concepts. And they're just questioning both sides of the equation because that's what you do when the tape gets a little bit iffy on the market leaders. They're
Mhm.
questioning the free cash flow of the Mag 7, which those are the ones that are supposed to be disrupting. And so, well, wait a minute, if you're spending all this money to disrupt, then, it's like this. And at the same time, they're bearish software. That doesn't, is it one or is it the other?
Right.
So, but the reality is this is all ice cold. Mag 7 is ice cold. Software
Which
is ice cold. Uh-oh.
which you were
Brand
talking about
X.
here.
It's okay. We love our friends at State Street.
Oh, oh yeah. You
No, it's
covered that
fine.
up for a second. Just showing the performance. Sorry, I'll have to pull up the other tickers, but like you were saying, gold versus Bitcoin and what they've done recently.
Yeah, no, it's totally fine. It's an intimate industry. We have no ill will towards State Street, and we're competing against them in gold and competing against Van Eck
I
and all
know,
that.
I know. Well, I'm going to talk with Jeremy in a couple weeks here about the
Okay.
gold products. Specifically, gold's been a big area for me as well that I've very much gravitated towards. I added additional gold exposure last year, which worked out well going into this year. I've done a couple
Cool.
of these type videos with Peter Schiff recently, who's
Yeah,
been very
yeah.
much on that gold train. You guys have some unique, gold products as well. They're around that efficient gold investing. So I'm looking forward to that conversation. But yeah, just
Nice.
kind of trying to show there what you were talking about, that
No,
divergence that we're seeing.
it's totally fine. I'm just playing games with you. We have something called office hours at Wisdom Tree, which is a webinar that we do. We're doing screen shares. The
Yeah,
advisors are asking us questions, and I will
sure.
frequently put GLD on there as an example of to do a
Yeah,
review
yeah.
series. So it's normal. It's everybody knows that one. Well, don't worry, we'll crack into them.
Very nice, very nice. Yeah, I mean, you guys have, like, at Wisdom Tree just really become, I think, for a long time now, but a true powerhouse in this area when people go look at the amount of AUM, the amount of ETFs that can be found on here, domestic, international, fixed income,
Yeah.
alternative, capital efficient, thematic, crypto. It pretty much covers the full gamut of the across the board, right?
Yeah, it does. And I mean, just, talking shop and thinking the industry, it's really nice being the strategist at the firm because a lot of it is, hey, just tell me what you're looking for, and then I'll tell you about the concepts, right? Like, I mean, I like value here, but maybe you like growth.
Mm,
It's what makes a market. You flip a coin. Am I going to be right? Am I going to be wrong? Right? To the extent that you want growth, cool. Let's talk about the growth funds, right? And I'll show you how they play out. I mean, a lot of
sure.
the stuff that we've been putting out chart wise, like the dollar bull stuff that we are just looking at. I mean, it's forex. It's not easy, which is why actually that's why you should be currency hedged because it's so difficult to figure out currency pairs. But I could be wrong, and the dollar could keep going southbound. And you know what? Cool. We got gold funds, right? It's just whatever you're looking to do. So being the strategist at Wisdom Tree is pretty nice because and I'm not to say any names or anything. There's just a lot of players in this industry where you're stuck at a fund house and you have
Mhm.
one asset class. Oh, you're an emerging equity manager. You're gold only. You're a small cap. You're a small cap shop, and well, we're a little bit of all of it.
Yeah.
Europe, Japan, emerge. We didn't even talk about emerging. You got China funds, the whole nine yards. So it's nice. A little bit of everything under the sun.
Yeah, I mean, I know we're gonna wrap up here in a sec, but I'll definitely show people on screen just to show love to the Wisdom Tree gold side of things. This is one we'll be talking about in 2 weeks,
Oh,
GDE,
cool.
this
Yeah.
efficient gold strategy, and this has just been on a rocket ship at this point. It's up about 81% past year, 17% already year to date. People can see the AUM just absolutely flying, almost at 700
Mhm.
million already at this point. If you go back just a year, this was rocking about 50 million.
Yeah.
So clear attraction as well to the gold side of things across the board. So I think these are, I mean, just both topics fit super well as alternative areas that people may not have explored in their portfolios. I think a lot of my audience runs that classic satellite style portfolio. They've got a bunch of SPY, a
Okay.
bunch of QQQ, and then they build around it with individual stocks and ETFs. And these are things that people are starting to look at to potentially put in their portfolio: international exposure, small mid cap exposure, gold, things that have really benefited me. Personally on my end, I've been able to performed pretty well in the markets this year, even in a year where I'm pretty sure SP 500 and QQQ are relatively flat year to
Mhm.
date. I actually just got back into green. It's plus 40 cents on the year, 0.06 at the moment. QQQ is down about 2%. I would say it looks like right
Yeah.
now because of international exposure in gold. I've been able to be up about 4 or 5% so far this year, and so that's why to me it's just been something that I've been very passionate about having these conversations, sharing them with the audience, trying to show people, hey, there's other areas that you could potentially look at investing into as well. So I think that's just where the passion comes from. And so it's very helpful to have people like you who are actually then creating the research that supports this type of investing and putting together charts and showing people like, hey, it's that classic Warren Buffett, blood in the streets.
Exactly.
Well, being a contrarian, well, look at what the dollar is right now. There's nobody that's a bull in the dollar. Here's an
Yeah.
opportunity to make some money.
Yeah, and I appreciate all the kind words. And look, we have a ton of research at Wisdom Tree, and we'd be absolutely flattered for people to go to the website and read it. And like I said, over there on the website where you're showing, you drop down on the path tools, daily charts. It's a laundry list of charts. If you like macro and you like those big picture 30, 40, 50-year time series on these things, that's what it is. Because we know that that's what people want to see. They want to see something that's actionable and relevant, and we've had a lot of success with that. So I would ask everybody to go take a look and go engage DDWM too.
Yeah, go ahead, everybody. Add these right now to your watch list: EDWM, DDLS, and you know where to start your research on the Wisdom Tree section. Of course, you can go ahead and follow Jeff as well directly on X. Jeff, in
Yeah,
addition to for people that want to see the photos with the wife and the dinners and all those things, that's where they can find those, right?
not really. I have a whole concept. We have a small army of children, for example, and I don't post them on social media. She does. She puts them
Okay.
on Instagram and all that. But no, I have like my own personal rule. I won't put more than 3 or 4 photos per year
Mm,
on X because I just don't think anybody cares. I think
probably
that
healthy.
I think that it's like, hey, I'm following this guy because the manufacturing PMI print came out this morning and I want to see what the implications are for something that I'm freaked about or something I want to
Mhm.
get long. Not, hey, here's Weniger at the Cubs game with his wife. I don't think
Sure.
anybody cares. That's what I think. So,
That is fair. That is fair. Well, you do get a lot of great engagement on it. I encourage people to go check it out on Twitter at Jeff Weniger. Some of those charts that we just talked about can also be found there, as well as insights. There was a really good one that you posted about a week ago about 14 positive facts about stocks in the economy
yeah,
with
yeah.
all the doom going on. So, encourage people to go read up on those. Any final comments you'd want to share on the live stream today?
Just if you've been with us for the 20 year, it's been 19 and a half years since we launched the originals. Then all I can say is we are just so grateful for those of you who came in summer of '06 when nobody have ever heard of us, investing in these new mandates that were something other than cap weighted ETFs.
Mhm.
And now here it is 20 years later, this established money manager with, I don't know, 80 or 90 ETFs. We're just beyond flattered for those original investors. And thank you to them.
Yeah, I think when you look at the largest ETF firms in the world by AUM, I assume Wisdom Tree is what, top 15?
Yeah.
Kind of in that area. So pretty
Yeah.
pretty vaunted place to be. So
Thank
congrats on all
you.
the success that you're from Messine. To my audience, firms that are in that area typically are doing something right. Place to go look, check out the research. The research is free as well, which is incredible. And I appreciate you, Jeff, for coming on. I'm looking forward to this conversation with Jeremy in a couple weeks.
All
We're going to
right.
be on a space for that. If you end up
Cool.
wanting to join the space, feel free to. We'd be happy to
Dun,
have you
dun,
on too.
dun.
So we'll see. We'd love to get you on more of our shows.
All right. Thanks, Scott. Much appreciated.
All right. Thank you, Jeff. Thank you to everyone that tuned in on Wolf Financial Live here. That's going to do it for the show. We'll wrap this up. This will turn into recording once we finish. You can rewatch it from the beginning on Twitter or YouTube if you missed any of it. Feel free to send us any questions that you have, and we'll answer them on an upcoming show. And of course, tons more programming coming